This is Tom Fox. Welcome to the newest edition in the Compliance Podcast Network. My latest podcast, Compliance and Coronavirus. As the voice of compliance, I wanted to start a podcast which will help bring both clarity and sanity to the field of compliance, the compliance practitioner, and indeed the compliance profession during this worldwide health and healthcare crisis. Taking up a variety of topics as diverse as working from home to sporting events, to the role of the board of directors, to crisis management, to the role of supply chains. We will look at all of these in this podcast. If you have a topic you'd like covered on compliance and coronavirus, please let me know. I'd be happy to do a podcast on it. We will post on Tuesday, Wednesday, and Thursday at 9 a.m. Central Time for the foreseeable future as we navigate our way through this incredible crisis. First, a word about our sponsor, SAI Global. With the coronavirus and COVID-19 pandemic continuing to change rapidly, trust and integrity are paramount to business continuity preparedness. SAI Global is here to help compliance and risk professionals facing these challenges, including unprecedented business impacts from employee well-being to disrupted supply chains. SAI 360 is a cloud-first software and modern ethics and compliance learning platform designed to help you navigate risk from every perspective. To learn more about how you can protect your business operations and workforce during these uncertain times, visit saiglobal.com/risk for free resources, expert guidance, and industry-leading technology. Thanks again to SAI Global for sponsoring this most important podcast. Today I have with me John Petrovski. John has been in the commercial real estate business for 35 years, and Jim Belin, a self-styled contrarian investor from Phoenix. We talk about the economy coming out of COVID-19. All views of the guests are their individual views only. Hello, everyone. This is Tom Fox, and you are in for a real treat today because in this episode of Compliance and Coronavirus, the podcast where we bring you clarity and sanity about COVID-19 health crisis and the attendant economic dislocation, I'm joined by John Petrovski and Jim Belin, two of my very best and longest friends. And we are going to consider how the economy may return from its current state, what it may look like in the fall of this year, in 2021 and beyond. So, gentlemen, first of all, welcome and thanks for taking the time to visit with me today.
Thank you, Tom. Glad to be here.
Tom, thank you.
So we have all been texting, emailing, pontificating, occasionally Zooming on what the economy might look like in 60 days, 90 days to the end of the year. So I wanted to maybe get your thoughts on, we live in disparate parts of the country. John is in Illinois, Jim is in Arizona, and I, of course, am in Texas. Our states are reopening really at different times and through different phases. But what do you guys see in your states around not only reopening, but businesses reopening?
Yeah, I'm happy to. Thank you. Thanks for having me, Tom. Yeah, I've been in Illinois most of my life, and it's a very interesting state to be in right now. I'd say we're in the stay-at-home phase still, where some non-essential businesses are allowed to open, but for the most part, the state is on stay-at-home, what I call in the hole. We're sort of like in solitary confinement. And that's going to end, we think, sometime in May. And the mayor has the mayor of Chicago also, but the governor of Illinois, Mr. Pritzker, has a 5-phase program. And we're in phase 2, which is the flattening of the curve. And then in phase 3, we get to closer to near normal and more businesses open with face masks and limitations on distancing, et cetera. And then with phase 4, you get to go to groups of 50 people or less, and bars and restaurants get to open in phase 4. And then phase 5 is full economy with the vaccine in place, and people can go back to doing what they did in February of 2020. And there's a lot of controversy in Illinois because the bars and restaurants would like to open ahead of phase 4 instead of they'd like to do it in phase 3. But the state still is on heavy social distancing, masks outside, and a lot of businesses closed. So it's a tough time. And then so we're in the hole. I think it's going to be for till the end of the month. And then in June, July, it'll be the crawl out of the hole, which will take a number of months. And then we'll get to a temporary new normal in September, which I'm happy to describe. And then with the vaccine, we'll get to what I call the new normal, which will still be different than what February of 2020 was.
Jim, what about Arizona?
Arizona is reopening for business, and I'm flat out scared. Every day in April, the number of coronavirus cases in Arizona increased, and yesterday was an all-time high. We're close to 10,000 cases. Bars and restaurants aren't open except for carryout, but retail is going to open in the next week or so, almost everywhere. And it's at Arizona State. The state of Arizona had engaged some scientists at Arizona State to do some modeling about expected coronavirus case growth in Arizona. And under their models, the only scenario where coronavirus cases didn't explode is if you would have had stay at home all through May. And that isn't happening. So it remains to be seen. One area I'm particularly concerned about is in long-term care. Long-term care facilities in Arizona, they've had outbreaks of coronavirus cases, but the long-term care facility isn't disclosing how many cases there are, and the state isn't making the long-term care facilities disclose how many cases there are. So it's a problem. In Arizona, I read yesterday, ranks last in testing. We ranked 51st, so we were behind all other states and the British and the District of Columbia. So we're not in a great shape. And this will be it will be interesting in the next month to see whether this theory that the coronavirus disappears in heat really is true, because we've had 100-degree days already, and it's going to be in the high 90s for the next week, and we'll see what happens.
Well, gents, as our states collectively work through these phase reopenings, the next area I really wanted to get your thoughts on are what might the economy look like? Is it going to be by region that things start to turn around? Is it going to be by industry? Will it be a combination of both? Obviously, the energy industry, where I'm located in Houston, has been severely dislocated, both from the coronavirus health crisis, the attendant stay at home, so people aren't traveling. They're not going to travel for summer vacations, but also the international component of it. But what might it look like in areas of manufacturing, John, and in the Midwest? And Jim, with Arizona coming through the summer, is that a high travel season? I know they're talking about Major League Baseball relocating perhaps to Phoenix. What do you guys see in terms of the economy?
Well, I think clearly the economic impact has been unprecedented in terms of speed and severity. And you look at the unemployment today is around 15%. It was published this morning. That's probably understated because it's playing catch up with the stats. So, like I say, we've been on lockdown. And when we come to the 2-month crawl out of the hole segment, it's not going to open up all at once and bring back like a rubber band. The V it's not going to be a V. People talk about the Nike swoosh and what's the slope of the swoosh. And I kind of think it's going to be a lazy W. It means that the front end came down quickly, and from there it's going to ramp up slowly with some speed bumps along the way. But you'll see increased opening, and I think the next month is going to really be telling. If people are able to open up, if the canaries in the coal mine not too many of them get sick in the coming month, then the country and different states will feel confident opening. If we have more illnesses, you could have local lockdowns again, which again will set us back. So I think I think the summer is going to be a bumpy ride.
Jim, what about Arizona?
Summer is always a slow season in Arizona. You'll have traditionally the hotels would drop their rates, and so you could have a 5-star hotel able to stay there at $100 a night, but no one's going to go stay at hotels. I mean, I just don't see that happening. Phoenix is a very service-based economy, and I see real problems because there's small businesses that have been hurt, and I'm not sure they're going to have the cash to survive. I'm not a believer in the V-shaped recovery, and it just irritates me that you have Steve Mnuchin and a lot of the Wall Street strategists continue to stress a V-shaped recovery. It's baffling to me that in the stock market, the NASDAQ 100 is positive for the year. Here at 15% unemployment, and 91 out of the top 100 companies in the index have cut their earnings estimate or created losses, and the index is positive for the year. So it's I don't understand it myself.
Well, the stock market's a forward indicator. And so people buying stocks today are buying what they think the earnings are going to be in the next 12, 18 months. And so they're willing to jump in early to take advantage of that. But like I've heard these stock analysts say, we'll get back to December of 19 run rate on earnings per share. We should get that to early next year. I don't, I'm a little bit, don't think that's accurate because there's some industries that are just not going to be back to full tilt by early next year.
Consumption is 70% of the gross domestic product. And where's consumption? I mean, Americans, there are a lot of Americans, 30 million Americans out of work? I mean, they're wondering, like, how are they going to pay their next month mortgage or rent? And where's the spending money going to come from to drive things back to where they were, in 2019? I think it's very interesting to look at Warren Buffett. Now, here's someone in the recession in 2007, 2008. He was a buyer. He was engaging in deals. A lot of them were convertible preferred issues with banks. Right now, he's sitting on $137 billion in cash. He, if he wanted to, he could go, put the money to play. But in the first quarter, Berkshire Hathaway net, invested about it was like $1 billion in stock. It was like, for them, a very, very tiny amount of money. He's not the only long-term investor I've heard who are just like sitting on their hands because they've never seen so much uncertainty in their investing lives before.
Gentlemen, we are going to take a short break, but when we come back, we're going to take a look at some specific areas around economic issues, and I've got some questions that I hope will be of interest. This is Tom Fox. If you are a compliance professional, if you're a compliance officer, or you want to move into the compliance profession, I would urge you to check out my newest podcast, The Compliance Life. In The Compliance Life, I interview one chief compliance officer per month in a 4-part series about their experiences in moving to the chief compliance officer chair. We take a look at how they got there, what they've done after they've got there, where they may be going forward, some of their toughest experiences, and what it's like to sit in the chair. So check out The Compliance Life. It's available on the Compliance Podcast Network and iTunes. Now, back to Jim Belin and John Petrovski. Gentlemen, I had some specific questions I wanted to throw out to perhaps get your look at the veiled land of the future down the road on. We all have the luxury of working from home, so we've been able to continue our professions during the COVID-19 health crisis. But what or how might working from home change the business-to-business models that we have all grown up with? John, you want to start us off?
Sure. Well, have worked in commercial real estate lending and investing the past 35 years, and this will have some short-term obvious impact on commercial real estate, but also, I think, permanently. The work-from-home phenomenon has proven to be very viable, and I think in the past people were reluctant to do, and their managers are reluctant to allow it to be done to any great extent. I think coming out of this, you're going to see managers much more open to more work from home. You'll see companies do maybe more office sharing, which means that the demand for office space could be down a notch.
Jim, what about your perspective?
Well, I'll just speak generally. One of the concerns I have is about inflation. We haven't worried about inflation for quite some time. I think that the whole coronavirus, you're going to have supply chains move back onshore. That's going to create more employment, although I think that a lot of the factories and whatever will be more automated than they would before. But if you have facilities moving onshore, manufacturers will be more costly, including social distancing issues. I think productivity is going to go down. So you see inflation there. I see in the whole agricultural area disruptions in the supply chain. It's happening now. I'm particularly concerned. When I see these stories about people lining up, for quite a long distance for food banks, how we can do a better job of getting food from the farmer end to those people. It's a real problem because the processing companies, they're used to sending a whole amount of produce into the restaurant trade and in the commercial trade, and that's not going to come back. It's going to come back, but not, I don't think, to prior levels.
Could the phenomena of sourcing locally for restaurants be modified to source locally for food banks or other distribution nodes?
I've read that in New York is actually state is sending money to the farmers and working to build a network. They had it last weekend, and on 60 Minutes they had the famous chef Andres, and he's organizing distribution through restaurants, and so the food goes into the restaurants, and he has people who worked in restaurants making it and then distributing it to food banks. I mean, we're in unusual times. This is.
So, as you know, our listeners cannot see us, fortunately. Nevertheless, we all are near the at-risk categories for coronavirus. So one thing I've been thinking about a lot is testing and a vaccine. Does the concerns I have personally, do they expand out to how you guys are thinking about not only successful reopenings of businesses, but also an economic uptick as well?
Well, certainly an effective, easy to get vaccine that gets us back to confidence in February of 2020 would be great. The reality is it's going to take a while. Even with these most successful vaccine tests, they have to redo them again. And there's just a thoughtful process that's going to take some time. But even so, once the vaccine is here, which I'm confident it will be, this is going to be, as Sam Zell said, like a lasting scar, because it's like our grandparents lived through the Great Depression. Our kids and our grandkids are going to remember the recession of the pandemic of 2020. And it's going to shape how people travel, how they congregate, how they spend money. One thing we didn't talk on is unemployment is one thing. There's a number of places that have just cut pay. A lot of law firms have cut pay 20% on base salaries. So when people are making less, obviously they're spending less. So that's going to be a downdraft on the economy. It's going to take 2020 to climb out of this, I fear.
I mean, personally, I'm not about to go to a movie theater anytime soon. I like Major League Baseball. I have no plans, even if baseball comes back, I have no plans to go to a stadium or to a concert anytime soon. Vaccine for me can't come soon enough.
So one of the things that, as I said in our first segment, that I think about a lot, obviously, is the energy industry. John, you touched upon commercial real estate. Are there any industries or sectors, rather, that you guys think could literally be changed forever? The sort of WeWork office share model immediately comes to my mind. You mentioned services and entertainment, Jim, that may not come back in 2020. Are there other examples you can think of or that you're watching or considering along those lines?
Well, certainly retail is getting a lot of press these days, and retail had been on a downward slide. When I say retail, I mean brick and mortar retail, as the internet sales and Amazon have eaten into market share, and even more importantly, have eaten into margin. So retail was on a downward slide anyway, and this pandemic has just accelerated that. You saw Lord & Taylor filed bankruptcy, Neiman Marcus filed bankruptcy. They say large number of the department stores may not make it. Half of them may not make it through this. So there's a lot of malls that will be impacted by this. So that's going to be front and center, an acceleration of a decline that was already underway. And of course, the hotel industry has really been rock solid. Now, I'm confident that has a good potential to come back to 100%. It's just a question of is it early 2021 or is it 2022?
Jim, what about your perspective?
Well, I think we're going to see a lot of change in industries just from social distancing until they get a vaccine. But even like an airline, they're now not going to sell middle seats. Well, if that's I think is the proper thing to do. But my guess is that airfares will go up substantially for Americans because they've got to find some way, to spread the fixed cost of the plane. And restaurants, I worry about a lot of small restaurants, how they're going to survive. If you have social distance, you're not going to have as many tables, being filled. So these are problems that I see there.
Let me change the focus just a little bit to the long-term play for equities and the bond market. You guys both previously talked about equities in the stock market and the forward-looking nature of the market right now. It's up, whether that is due to the Fed, whether it's a variety of other factors, whatever they might be. But what do you guys see in terms of long-term, and I guess I should define that, 3, 6, 9 months out, but into 2021 and beyond for equities versus the bond market?
The fixed income market has been low and in a bull market for the last 20, 25 years, which means rates have been coming down. And every time somebody thought they can't go any lower and that their rates are bound to go up, the bond market proves them wrong and rates go lower still. And I think the 10-year Treasury this morning was like 0.65%, which is unheard of what anyone would have thought as short as a year or 2 or 3 or 5 ago. So fixed income doesn't pay anything. It's a safe harbor for large sums of money. If it's a great time to be a borrower on a home mortgage, or if you need to borrow money, go out as long and as low as you can. That's smart. It's one of the reasons why the stock market is so bullish today is people look at the returns in the fixed income market and feel like, I may as well jump in the stock market and wait it out, and in 3 years I'll be ahead of the game, versus if I own a 10-year Treasury, it might actually lose value over that time period.
Jim?
I'm a contrarian investor. My allocation to bonds is zero. There's no return in a bond. A sovereign bond, there's $15 trillion of bonds globally, sovereign bonds, that are trading at negative interest rates. So that isn't attractive at all. I would urge your listeners to avoid a lot of bond exchange traded funds. A lot of the bonds in those funds are going to be illiquid. There hasn't been a lot of price discovery, but when there is, I expect they'll have to be remarked to market then. So I would be careful about bond ETFs, junk bonds. Everyone's still putting money into junk bonds because they feel that the Federal Reserve has got their back. The Federal Reserve is backing some junk bonds, but they're not going to back all of them. It was ones where they previously had a good rating before March 20. You've got a nation where we have 20% unemployment if you include people who've quit looking for a job. I think there's going to be a lot of deterioration among some of those credits. So I'm not interested in junk bonds.
Jimmy, inflation or deflation?
You can have inflation in a lot of things like services. Like I should say, not services, but I mean like goods. I expect food inflation to be much higher next year. Energy is super low now. I expect energy to be higher over time because at $20 a barrel oil, no one's making money at that price. I think you're going to have big shutdowns of oil in places around the world. I think that my advice for people need income in a time of zero interest rates. My advice is don't be a yield pig. Don't necessarily go for the stock that pays the highest dividend. You've got to make sure that dividend is sustainable. So you might check and see, compare, look at the earnings and see what proportion of the earnings the dividend payout is. I think that for companies with little or no debt, their dividends are good. The dividends in consumer staple companies, probably good. But you're going to have to look at the balance sheets of the companies that you own stocks in. There have been some surprises. Who ever thought that Disney would omit its quarter dividend? I mean, that's a company that I never thought would omit its dividend. You've had big oil majors like Royal Dutch Shell. That's a quality company. They just slashed their dividend by more than 50%. Maybe that's it's sustainable at that level. It's possible. So I think it's important to look for some yield, but to be smart at looking for some yield. And then precious metals is an area I like. It's no institutions aren't invested in it at all. If you look at in the mining sector, gold mining companies, they're going to have higher revenues and higher cash flows this year versus last year. How many industries can say that?
My hat's off to you, Jim. It took you 22 minutes to get the gold.
Well, gentlemen, we unfortunately are near the end of our time, but there's a couple of things I wanted to end up with from both asking both of you guys. Number one, are there any resources that you are following that you could direct our listeners to, and or key economic indicators you're following? Jimmy?
I would urge people, I mean, you turn on CNBC and you get the same cheerleading opinion day after day after day. So I think it's important for your listeners out there to take a look at people who have alternative views. So I would suggest you go to Horizon Kinetics. I don't own their mutual fund, but people like Steve Bregman and Murray Stahl, they're very thoughtful investors. They have a contrary opinion on things. I think that I pay to subscribe to some people's newsletters, but you can get some of the same information by following their Twitter. So go to Twitter, follow people like Fred Hickey or Jim Grant at Grant's Publication on Twitter, or Stephanie Pomboy. These are people who I think are very smart investors and have contrary opinions. It's worth listening to.
John?
For economic data, I go to Moody's.com, and they've opened up their website to offer some free economic projections on real estate, et cetera. And they have a COVID a website. And then for the virus itself, I go to the Johns Hopkins website, coronavirus.jhu.edu. And also there is another website that projects cases and the mortality that's useful is covid19.healthdata.org.
Well, gentlemen, we are unfortunately now at the end of our time. This has been a ton of fun. It's something I've wanted to do for a long, long time. So thank you both for taking the time to come on and visit with myself and my listeners.
Glad to be here.
Very nice to be here. Thank you, Tom.
Hello, everyone. This is Tom Fox again. I'd like to thank you for listening to this episode of Compliance and Coronavirus. If you have any questions or you have a topic you would like explored on this podcast, please shoot me an email at tfox@tfoxlaw.com. Also, as a call to action, I would ask if you could to please tell one of your friends about the podcast so we can spread the word out about the newest podcast on the Compliance Podcast Network. Also, if you would leave us a rating on iTunes or a review, it would greatly help get the word out about this most important podcast over the next several months. Thanks again for listening, and I hope you'll join me for our next episode of Compliance and Coronavirus. This podcast is a production of the Compliance Podcast Network.